Good afternoon. I'm Will Woodall. I'm joined by, as usual, Mike Rarey. Hi, Mike.
Hi, Will.
And today we're going to take a look at April. The saying April showers was not accurate. It was more like April hurricane. And we're going to take you through the market summary. We're going to talk about the volatility, and then we're going to sort of help you understand our investment framework and how we look at all of this volatility and what's happening in the markets in order to give you some perspective on the things that we and you should be looking out for going forward. We're going to start by going through the returns for the month of April, which were awful. I think worst start to the S&P since the 30s, perhaps, and terrible start in the bond market, perhaps worst ever.
Yep.
Ever's a long time.
Definitely.
So take us through the board.
Yeah, the column furthest to the left, these are returns just for the month of April across asset classes. So starting out, the S&P 500 down 8.7% during the month of April, brings us right back down to the lows from prior in the year that we've hit multiple times throughout the year. So down almost 13% year to date. Small caps down a similar amount, foreign stocks down not as much, but also down a similar margin year to date. And then the bond market didn't let up either. The new information was getting more clarity around the pace of the balance sheet runoff that the Fed is likely to start in May at the FOMC meeting coming up in just a few days. And then also now more rate hikes priced into expectations. So seeing rising interest rates again. U.S. Treasuries had their worst quarter ever in Q1 and then posted another month of losses.
Yeah, and all of this red is the result of just one rate hike.
Thus far, we've only had one rate hike. That's exactly right.
But as you said, the expectation for 10 rate hikes. So let's dig in a little more and talk about the path of the S&P and give some perspective on what has transpired, because it has been quite volatile. And
Yes.
Distinguishing between growth and value, I think, is important here.
Definitely. So this green line is the S&P 500 price level throughout the year. These are 30-minute ticks. So that's why this looks a little more active than your typical looking at last market close chart. Yeah. So once again, started the year at the high, at the 52-week high. In January, got down into the 4,100 level. That was our first dive into technical correction territory, so down more than 10% from the high. Then we have Russia invading Ukraine. That's our next bout down here in the 4,100s, consolidating again into the April or the March FOMC meeting. And so we've been down here a lot. We formed a bit of support, hopefully, some technical support. And now you see a rally into March, late in March, and then April is pretty much down the whole way. So finishing the month of April at the lows for the year, right down here, 41.31, where we've been multiple times throughout the year.
And looking at the grid we have up here, distinguishing between growth and value.
Yeah. So looking at this grid in the center of the screen, top to bottom is large to micro cap, left to right is value to growth. So the darkest red is all on the growth side of the equation. And that was sort of, growth has been underperforming value all year. But what we saw additionally in April was some of the, MAGA F, FANG type stocks, those mega cap growth companies, finally starting to show some weakness in earnings. I mean, it's something we haven't seen in a very long time. Amazon missing estimates, Netflix missing estimates. And so even the leaders in the market for, years, seeing some fundamental weakness here in April.
A big theme of what you just said is sort of relating to the pandemic winners and losers.
Yeah.
And the COVID winners are now the post-COVID losers?
Definitely. Yeah, looking at some of the pandemic winners, so we have here Peloton, Spotify, Netflix, PayPal, Zoom, and Teladoc. And this is just a handful. I mean, you could add 10 more stocks to this list. These are all growth stocks.
Yeah.
You would expect them to be down this year. But now we're looking at the fact that they've basically performed a round trip here since the pandemic. So this is growth of 100 for each of these stocks since March 1st, 2020. And the highs were high, and now all of them are underwater. So all of them have losses, even though the majority of these businesses have grown during this time period quite tremendously in terms of users, subscribers, market share, et cetera. To see how negative the technicals have been around these names and the amount of short interest we're seeing now really getting beaten up. And once again, these are all growth stocks, and they're contributing to that weakness in growth stocks relative to value stocks.
And how much of this is just that ebb and flow of the cycle versus interest rate expectations rising?
Yeah, definitely interest rates rising and expectations for rate hikes rising were the catalyst. I mean, a lot of these stocks were really hanging in there heading into last fall, and it was looking like they were just going to sort of consolidate gains from the pandemic. And now the next leg of rapidly rising rate hike expectations created a tremendous amount of weakness. And then, these are very much momentum stocks, and so momentum works until it doesn't. So once the momentum was gone, they really have gotten beaten up quite a bit by short sellers.
But like you mentioned, these businesses generally are better positioned now than they were pre-pandemic. I mean, we saw some weakness in Netflix subscriptions, but generally speaking, these businesses are in better shape than they were before. So we would expect them to embark on a recovery once rate expectations moderate.
Hopefully, once they level off, if they come down at all, that would be great. But yeah, I think that's exactly right. You think about all the volatility we've had here year to date. The S&P is only down 12, but it feels way worse than that.
Sure does.
Right? Because it's been over 4 months. It seems like we're treading water. And a lot of the things that were doing well, the past leaders, are getting hurt the worst.
Right.
And you look at some of these stocks now, and you look at the valuations relative to the fundamentals, and it's starting to get a little crazy. It's starting to get to the point where if you're short these stocks, you always play it from the opposite end. If you're short these stocks, you are thinking about covering. You must be thinking about covering right now.
At some point, you're getting close.
Eventually, it gets so bad it can only get better, and the shorts cover. When you cover your short, you have to buy the stock, and this can hopefully find a bottom here and start to recover.
Yeah. So let's move on to the rate hike expectations, because we have set a new high here. I believe 10 plus rate hikes expected. We've had one.
Yes.
There is quite a buildup in expectations. And before we dig into the chart, what is driving the rapid increase in expectations?
Yeah. So one was the fact that March CPI was 8.5%. The Fed thinks they are very offside, and they are talking about how offsides they are and how they are willing to do whatever it takes. So a tremendous amount of Fed speak. Jerome Powell, for the first time in April, endorsed a 50 basis point rate hike. Other FOMC members were talking about the potential to hike rates quicker, maybe a 50 basis point rate hike. Jerome Powell never felt the need to say it until this month.
Right.
And the market has run with that quite a bit. And the Fed's in a very difficult position right now.
So we've hiked once.
Yep.
Stuff's already breaking.
Yep.
We just had a negative 1.4% GDP print for Q1, which was a surprise. Can they get away with this?
Yeah, 10 more hikes, 6 meetings left. So you're going to have quite a few meetings where you're doing 0.5% in order to live up to these expectations. It's going to be difficult. If they're going to do it, they better do it quick. Because the longer it takes for them to do this many hikes, the more time they have to see the negative economic and market impacts of what they're doing. So you start to go through the meetings.
Right.
So May 4th, they're not even going to have a look at April CPI yet.
Right.
So they're going to go. They're going to go 0.5%. And then you think, well, we just saw a negative GDP print in the first quarter. They're going to parse through that. That was really a net export story and an inventory drawdown.
Right.
They're going to say these things are volatile. I'm looking through that data to consumption, to investment. That was all strong. Not even worried about that. So May, they're definitely going to go. June, by the time they get to the June meeting, they will have a couple more months of inflation data, won't have another month of GDP data. So they're still probably going to have enough to go. Because even if inflation starts coming down, it's not going to come down enough between now and June 15th for their outlook to materially shift. And so then you finally get to July, you know, that might be the first time where they give a dovish hike, because you might actually start to see some of the negative impacts on growth, and we'll see where markets are at. Maybe they could do a dovish hike there, and you don't really get to under delivering until September.
Right.
Is your first real opportunity to say, hey, we've actually done enough here. We can start to bring this back.
So you could see 50-50 and then maybe 25-ish here.
Yeah. 25 or another 50, but hey, this is our last 50 is in the conversation afterwards.
Well, that would take us to, what, 7 hikes?
Yeah. Yeah. So we get close. The hope for the market right now is that this line just stops going up.
Mm-hmm.
If the market can just stop expecting more front-loaded hikes, that will probably be enough to, you know, you look at a lot of areas of the bond market, you're getting a good yield. I mean,
yeah,
you're getting 2.75% on a 2-year bond now.
Yeah, you're getting
that's
3%
pretty good
on a 5-year as of
What's
right now.
keeping you as an investor from buying longer-term bonds? Well, it's this chart. It keeps going up. So once it levels off, then hopefully longer-term interest rates will level out.
Yeah.
And that will hopefully give investors a lot more confidence to start to seek out some of these attractive valuations in some areas of the growth areas of the equity market that have been beaten down.
Yeah. So let's just say they get away with 6. So this is 6 here. How much devastation does this create on the growth side of the equation?
I mean, if they hike this aggressively, and interest rates keep going up, you know, growth stocks are already down a lot. That's the good news. They're still expensive though, relative to history.
Sure.
There is more room for them to come down. So, you know, you could definitely say another 10% down for the growth areas in the market.
Mortgage rates are already above 5%.
Yep.
So this takes them well into areas where the housing market would probably slow significantly.
Right, right. And that's exactly what the Fed wants. They want housing prices to stop going up, so rents stop going up, so inflation stops going up.
Yep. So they're definitely going to try to break some stuff.
Yes.
Okay, so given all this, our outlook really has tilted heavily towards the bear case, and I would say we're living it right now. We're in the bear case. Where do we go from here?
Yeah. So near term and then longer term. Near term, we're at the bottom of the range for most equities. The technicals are really ugly, and we should be at the point where in the near term we can see some type of a bottoming, which will give another opportunity to reduce equity risk at better prices later. This is a very similar setup to the last FOMC meeting. So you had a lot of folks buying put options, shorting stocks heading into the FOMC meeting. Those options expire, the VIX comes down, options dealers have to cover their hedges that they were put on because they were selling puts, so they have to buy, shorts cover, and you get a short squeeze that almost looks like a rally. We're not saying that's going to happen, but there's potential here. It seems very similar. So we think you're probably going to get a better chance to de-risk, hopefully within the next 1 to 3 months. From there, you look at liquidity, growth, inflation, recession. What does this mean? Well, pretty much unequivocally, this environment sets up well for bonds. Yields are relatively high right now because of all the interest rate hikes that have been baked in. Slowing liquidity environment is great for high quality bonds historically. A slowing or moderating growth environment with recession risk that can pop up out of anywhere is usually great for high quality bonds. And then inflation, high and falling, important is the falling part, is generally good for bonds as well. So that's great because now if we de-risk here, we have something to get into that's relatively attractive given this macro regime.
Right.
And there's still opportunities in the equity market as well. This lineup of low and falling liquidity, moderating growth, slowing inflation, it's not bad for value stocks. And they're cheap, relatively speaking. The only thing that this sort of spells out is growth stocks, it's probably not time yet, because this is a very difficult macro environment for growth equities, and they're still expensive. If you were a day trader, I'm sure you're looking at opportunities right now.
Sure. Oh yeah. If you're a day trader, for sure.
But if you're looking 12 months out, definitely don't have the all clear yet.
Yeah, and so I don't think it's ever been as important for the Fed to under-deliver for us to turn things around. If they continue down this path, things will continue to deteriorate, and the outlook will continue to get worse.
Mm-hmm.
So I think all things rest there. Midsummer-ish, we should know more about the direction for the remainder of the year.
Definitely.
Well, so thanks for joining us, and if you have any questions, feel free to reach out to us. We're happy to discuss our framework and our outlook with you and answer any questions you might have.